The 2026 AI landscape represents a seismic shift in global finance, characterized by unprecedented capital expenditure and escalating systemic volatility. As big tech hyperscalers accelerate toward a massive $650 billion capex boom, Morgan Stanley forecasts a pivotal technological breakthrough this year that could fundamentally redefine AGI benchmarks and industrial productivity. However, this aggressive expansion brings stark warnings from BlackRock's leadership regarding an intensifying digital divide and capital concentration that threatens to widen the global wealth gap. While generative intelligence is reshaping institutional investment strategies through advanced predictive modeling and automated risk parity, analysts caution that such rapid integration may trigger profound stock market instability. Compounded by rising concerns regarding astronomical P/E ratios, there is a growing consensus that AI equities are entering overvalued territory, heightening the risk of a significant hype cycle correction. Investors are now forced to navigate a high-stakes environment where the promise of a transformative intelligence economy competes with the looming specter of speculative bubble bursts and algorithmic-driven liquidity crunches. Ultimately, 2026 stands as a watershed year for market resilience, requiring a sophisticated approach to mitigate the risks of disruptive automation and fiscal overextension. BlackRock CEO warns AI will widen wealth gap. BlackRock CEO has issued a chilling warning, and it's something the world cannot ignore. We are entering a new era where artificial intelligence isn't just transforming industries, it's reshaping the very structure of wealth itself. As generative AI merges with massive institutional capital, a dangerous shift is unfolding. Machines are no longer just assisting humans, they are replacing high-value cognitive work. This is capital versus labor on a global scale. Imagine a world where the owners of AI, those who control data, algorithms, and computing power, see their wealth grow exponentially while millions of skilled workers face stagnation or even displacement. This is the rise of a winner-takes-most economy, where opportunity concentrates at the very top, and the gap between the rich and everyone else expands at an unprecedented pace. Productivity is soaring, but who truly benefits? Not the average worker. The gains are flowing to those at the center of the AI revolution, creating a new digital divide unlike anything we've seen before. This is not just an economic shift, it's a structural transformation of society. The question is no longer if this will happen, but how far it will go. Without bold action, without rethinking how wealth is distributed in the age of AI, we may be heading toward a future where inequality is no longer just a problem, it's the system itself. $650 billion AI spending boom by big tech hyperscalers are currently engaged in an unprecedented capital expenditure, CapEx, arms race, with projected outlays across the big tech cohort reaching a staggering $650 billion in 2026. This aggressive fiscal deployment is no longer just about cloud expansion. It is a foundational play for compute dominance. Investment is flowing into Tier 4 data centers, custom silicon, ASICs, and localized energy grids to support the astronomical power requirements of next-generation foundational models. From a fundamental analysis perspective, the market is closely scrutinizing the time to value for these massive investments. While the narrative focuses on the long-term ROI of artificial general intelligence, institutional investors are demanding clear EBITDA growth and margin expansion in the interim to justify such historic levels of resource allocation. This spending boom has created a massive tailwind for the semiconductor supply chain and specialized REITs, but it also raises the stakes for quarterly earnings. Any perceived slowdown in AI-driven revenue monetization could lead to a sharp reassessment of these valuations, as the gap between infrastructure spending and tangible enterprise adoption remains a critical metric for 2026 market stability. Morgan Stanley predicts major AI breakthrough in 2026. Morgan Stanley's quantitative research team has identified 2026 as a pivotal inflection point for AI, forecasting a breakthrough that transitions models from statistical prediction to autonomous, multi-step reasoning. This shift toward agentic AI represents a paradigm change where systems can execute complex workflows with minimal human oversight, potentially unlocking trillions in industrial productivity. The firm predicts that the integration of symbolic logic with neural architectures will solve the hallucination problem, making AI reliable enough for critical infrastructure and legal applications. For the financial markets, this breakthrough is expected to trigger a massive wave of alpha generation, as companies that successfully integrate these autonomous agents see a step function increase in operational efficiency. The prediction has fueled a surge in sovereign AI investments as nations race to secure domestic reasoning capabilities. Morgan Stanley's thesis suggests that the winners of this 2026 breakthrough will achieve a durable competitive advantage, effectively moating their businesses against traditional rivals who are slower to adopt agentic architectures. Consequently, we are seeing a significant portfolio rebalancing toward R&D-heavy tech firms that are leading the charge toward these advanced reasoning milestones. AI boom could trigger stock market instability. A storm is building inside the global markets, and AI may be the spark that ignites it. As high-frequency trading systems and sentiment-driven algorithms take control, the speed of the market has reached unimaginable levels. We're no longer watching humans trade. This is AI versus AI, battling in milliseconds inside a massive black box ecosystem. Every headline, every tweet, every signal is instantly processed and reacted to. But here's the danger. These systems don't just respond, they amplify. Algorithmic feedback loops can spiral out of control, triggering violent price swings and even flash crashes in seconds. The surge in volatility, reflected in rising VIX levels, is already sending warning signals across the financial world. And in moments of extreme stress, something even more dangerous can happen. AI systems may all pull back at once, draining liquidity from the market. That sudden vacuum can send prices into freefall. Add to that model drift, where algorithms fail to adapt to unexpected economic shocks, and you have the perfect setup for a cascading sell-off. As AI takes over price discovery, the market is becoming faster, but also more fragile. The line between efficiency and instability is disappearing. In 2026, one question remains: are we in control, or is the system controlling us? AI could reshape investment strategies forever. The democratization of predictive analytics is fundamentally altering the asset management landscape, moving the industry away from historical modeling toward real-time, predictive arbitrage. In 2026, both institutional and retail investors are leveraging AI to ingest alternative datasets, ranging from satellite imagery to real-time supply chain telemetry, to gain a competitive edge. Traditional active management is being subsumed by AI-optimized risk parity strategies that can dynamically rebalance portfolios in response to micro-fluctuations in global sentiment. For retail investors, the integration of sophisticated robo-advisory tools has leveled the playing field, providing access to complex hedging strategies previously reserved for hedge funds. However, this shift also means that alpha is becoming increasingly elusive as the speed of information processing reaches its theoretical limit. The successful investment strategy in 2026 is no longer about having the best data, but about having the most sophisticated inference engine to interpret that data. This evolution is forcing a transition from passive indexing to highly personalized, algorithmic portfolios that are tailored to individual risk tolerances and ethical filters, effectively redefining the relationship between the investor and the market. 5. AI could reshape investment strategies forever. A new era of investing has arrived, and it's being powered by artificial intelligence. The rules are changing fast. What used to depend on historical data and human judgment is now driven by real-time predictive intelligence. In 2026, both institutional giants and everyday investors are tapping into AI to analyze massive streams of alternative data, from satellite imagery to live supply chain signals, all in the race for an edge. This is the rise of predictive arbitrage, where speed, precision, and machine-driven insight define success. Traditional portfolio management is fading, replaced by AI-optimized strategies that can rebalance assets instantly as global sentiment shifts. Even retail investors now have access to powerful robo-advisors, unlocking advanced hedging techniques once reserved for elite hedge funds. But here's the twist: when everyone has AI, true alpha becomes harder to find. The battlefield is no longer about who has the most data. It's about who has the smartest engine to interpret it. Investing is no longer static. It's dynamic, personalized, and algorithm-driven. Portfolios are now tailored in real time to individual risk profiles and values. This isn't just evolution, it's a complete reinvention of how humans interact with the market. AI stocks are becoming overvalued. The AI stock frenzy is reaching fever pitch, and danger is looming. Valuations have soared to astronomical heights, with price-to-earnings ratios that seem completely untethered from actual cash flows. Analysts are sounding the alarm, drawing chilling parallels to the dot-com bubble, warning that the hype cycle may have peaked and that reality could strike hard. While the long-term promise of AI is undeniable, today's market is caught in a high-stakes illusion. Sky-high energy costs, rapid hardware depreciation, and massive R&D investments are eating into profits, leaving many firms operating on paper gains rather than real earnings. Investors are pricing imperfection, assuming every AI pilot will scale seamlessly into a high-margin cash machine. But perfection is rare, and the gap between expectation and reality is widening. As 2026 unfolds, a dramatic flight to quality is emerging. Capital is shifting away from speculative startups and flowing into established tech giants with solid balance sheets and proven revenue models. Yet the risk of a bubble burst remains very real. The market is holding its breath, waiting for AI's true productivity to justify these stratospheric stock prices. One thing is clear, fundamental analysis has never been more critical, and the next move could define winners and losers for the decade ahead. If you're interested in this topic, give this video a thumbs up and drop a comment telling us what you'd like to learn next. Thank you.